Southeast Radio's Business Matters with Karl Fitzpatrick.
Southeast Radio.
Welcome back to Southeast Radio's Business Matters with me, Karl Fitzpatrick. My final guest this morning is a tax specialist, Brian Hennebry, and he's going to tell us why it's never too early to start tax planning. Brian, the headline-grabbing story in the tax world recently has been Apple and Ireland's success in the appeal against the EU's €13.1 billion tax ruling. But how significant is this appeal for the Irish taxation system?
Good morning, Karl. Good to be here. Well, I think given the scale of this, it actually probably transcends the Irish tax system. I think on one level it's a vindication for the position Ireland has taken. It's certainly a boost for the strategy we've had and the way the government has dealt with the EU on this appeal. Beyond that, it's largely historical in that things have moved on a long way from the figures that this appeal is dealing with. Apple deals with its tax in a very different way now, and the whole international tax system has moved. So I think it has limited impact going forward in that this process of changing the international tax system is already well underway.
But Brian, is it true to say that it will provide some level of reassurance to multinational companies that are currently located here in Ireland?
Yeah, I think that's probably the biggest thing in the credibility of Ireland and our tax system, and it vindicates the government's support for the revenue and being consistent. I think you're quite right. It's a little tick to say, okay, we're doing things properly. And when we say we have a low corporation tax rate and we're going to keep it, people will believe that more.
And Brian, how do you work with business owners to minimise their tax liability?
Well, I think part of the strategy of that is incorporation. We have a very low corporate tax rate, 12.5% for most trading and business activity. Compare that with what is probably about 55% the marginal rate of income tax when you take everything into account for an individual. So there's a huge incentive to use companies as vehicles for trading operations. And a lot of the work we do is designed around those structures. Now, because of the low rate and the advantage of that, there are a lot of regulations and conditions around the types of profits and the things company can do with its accumulated wealth. So I think when we look at the headline rate, 12.5%, we have to factor in then that the company is owned by the promoter, by a family. Generally, in most of business in Ireland is family operated. So we're usually looking at as a family business, and we have to take into account all the members of the family and their longer term objectives than just simply the immediacy of the corporate tax rate.
And specifically, what is the nature of the tax advice that your clients are seeking from you at this present time?
I suppose at the moment we're all in a slightly unusual situation, but looking at it just maybe slightly broader than that. I think the focus is very much on the long-term planning, so that what we're looking at is the involvement of family members in companies, shareholders, looking at the shareholders and the company as one unit, and then things like surplus funds within a company, how these are invested, how they're managed properly, and a significant factor too is how they're insulated from exposure.
Now, the vast majority of business owners don't seem to prioritise tax planning, but why do you think this is the case?
One of the main factors is any business, particularly when it's starting off, it's very dynamic. The focus is very much upon even survival in the initial stages. So then, and the individual who's promoting or running the company will very often be totally absorbed in that. So being able to see the bigger picture is difficult. And I think that's where external advisors can help. They can look at it from a distance and broaden the parameters. But very often people will get totally engrossed in minding the business, running it, expanding and so forth, and not take enough time to step back and have a look at where they're at. And part of that is built up, it reflects itself in maybe lack of tax planning, maybe lack of proper financial planning and getting strategies right for the long term.
And Brian, what are the most common mistakes that business owners make when it comes to tax?
I think maybe treating things a little too casually. I like a lot of problems that arise in tax with dealing with revenue and that are little things that go wrong that are allowed to fester. So I think at one level, attention to detail, making sure that little things are looked after. That, for instance, on payroll, that expenses are properly documented and that deductions that are being claimed in the business are properly documented so that you have the paperwork to support what you're doing. Because that is a big credibility thing, that if the paperwork is there and everything looks in order, then the assumption is, well, this looks good. And the converse, if records are a bit sloppy, there's the odd little thing going through that shouldn't, and it's obvious, then that's going to lead to an assumption that things are not quite what they should be, and therefore you'll get more attention or you're more liable to run into trouble.
Now, over 60,000 businesses have availed of the temporary wage subsidy scheme to date. But what are the tax implications of this scheme that both businesses and employees need to be aware of?
I think there are a couple of things that people need to be aware of. Within the employer who's availing of the subsidy, then the subsidy amounts are coming in and are paid out to the employee. That should be neutral. So the cost is booked as normal wages, but the income, the subsidy amount is set against that. So that should be neutral. I think there is a legacy issue in that the amount is paid to the individual, the employees, through the payroll system, but it's not actually subject to tax. So when somebody gets a subsidy amount in their paycheck, tax has not been deducted on that, but it is taxable income. So later on at the end of the year when what used to be the P60 comes out, that will show invariably an underpayment of tax because it is subsidy amount. And that's going to have to be collected in the tax system over the next 2 or 3 years. That is an issue, a time bomb that's waiting out there. Now, it's the individual employees who will have the liability. But I suppose like a lot of things, the employer needs to be aware of it, maybe make employees aware that there could be additional tax to pay on this.
And in many cases, Brian, the revenue have overpaid the subsidy amount to employers. So what is the process for repaying this overpayment to revenue?
You're right, particularly in the early period when the system was being developed. And it went live and it was developed. So to get it through, subsidy amounts were paid, and it was recognised that in some cases there were overpayments made to individuals, simply because there wasn't time to refine it. As it refined, those occasions decreased. There are still little tweaks that happen. But revenue will be looking to employers to reconcile all the payments that they've received from the revenue with the subsidy payments that have been made to employees. They will expect employers to be able to reconcile that, and where there was an overpayment, that it should be repaid directly to the revenue. And there is a system set up where employers can, once they've calculated that, they can refund the amount. I think what's important is that they clearly mark any refunds that have been made that are clearly documented, because with such a vast number of payments flying around the place, you need to be able to keep track of everything.
And tax warehousing is another useful cash flow support that Revenue introduced during the pandemic. How does this work?
Well, essentially what has happened is that any tax liabilities due after 1st of March, which would for most people, would be the January, February VAT, March, April VAT, and now May, June VAT, and the POE due by employers in that period. Normally, if they're not filed and paid on time, revenue will enforce collection, and at the very least, they'll charge you interest on the late payment. Their collection procedures and interest charges have been dropped for the moment, and they won't charge any interest for 12 months on those liabilities. After that, they will allow people a period of time to pay. They would charge a lower rate of 3% interest. Revenue's normal rate of interest for underpaid taxes is about 10%. So that 3% rate will kick in after 12 months. So essentially people have 12 months in which to organise a payment and make before revenue will take any enforcement action against them.
And is it true to say that the warehousing of tax only applies to taxes that were due to be paid between March and June 2020?
Yes, it was initiated with liabilities due after March. As businesses go back to some sort of normality in July, August, and they can open again, then those debts will become, the normal debts will become due. And I suppose one factor here, Karl, is where people have perhaps not paid the VAT for the last 2 or 3 periods. I think what they can look on that as a sort of a buffer, and that then as things become back to normal, that they can keep the future payments up to date and hold on to the buffer as being as a type of security that they can use to ensure they can get through the restart phase.
And from your experience and insights, Brian, do many business owners solely substitute a pension for proper tax planning?
I think pensions have, to a lot of people, are almost a dirty word. They don't want, oh no, I don't want nothing to do with that. Whereas, and I think part of the problem has been the pensions have been exactly what you said, used as a substitution for tax planning, saying, okay, we can put money from your business into your pension fund. You don't pay any tax on it. That's great. But that's not the solution. That's not the total objective. That's merely putting funds aside that you can access later on. It may be tax efficient to do it now, and it may make sense as a security for the future, but it doesn't work as a substitute for proper planning of your business and other strategies for enhancing your wealth.
And Brian, in your opinion, what does proper tax planning consist of?
Well, I think it's a holistic approach where you're looking at what someone's long-term plan is, then you're looking at the components of what they're at the moment, what the source of their income and their wealth is. If they have a business, how do we protect the business? How do we, for instance, I mentioned before that a lot of businesses are family-owned. So how do we bring in other members of the family and provide for passing to the next generation? Or is it a case that that's not going to happen, that this business is run by the current members, but it's going to be sold or it's going to be wound up when they're no longer capable of running it? So therefore we have a different strategy then to how we would develop a business like that with a view to selling it in the future.
And as businesses expand and diversify, the term group structure is often mentioned, but at what stage should a company consider creating this?
I suppose that again would depend on the individual, but by and large, what you'd be looking at with a group structure is when there are different components involved. So, for example, if a business is trading away and it has some surplus funds which it wants to invest, then it can do that. But that means everything is under the one roof, where at that point it might make sense to separate the investment side of the business from the trading operations, to keep them keep them isolated insulated from each other. Also, very often the trading side might have for instance, a management component where the owner might like to involve some of the senior management in the firm, perhaps by giving them some shares. But they might need to keep that separate from their own, either other businesses they have or perhaps some investment strategies. So two companies might suit that, where we have a subsidiary company carrying on the trade in which individual managers or key executives may have shares, and then an investment subsidiary where some properties are held or some investments are made, and maybe then a third one which could have some different business operation completely separate from the first. These structures can get quite elaborate, and sometimes people like me love to play around with these different combinations and things. But so I think, keeping a focus on, well, what are we at here? What's the key issue? Is the perhaps separating and then allowing different components to move in slightly different directions.
Now, in the months ahead, there will be plenty of opportunities for well-leveraged businesses to acquire other businesses. So for any business owner listening this morning that may be considering mergers and acquisitions, how can they do so in a tax-efficient manner?
Well, I think the key thing I would feel in that approach is to understand the target company. Because there would be some aspects of your own business that would maybe need to be tweaked with a new operation coming in. But very often the key tax component of an acquisition will be the tax position of the vendor. So if you, for instance, carrying on a business and you see somebody else that you might make a nice fit, then the attractiveness to that person depends very much on what they get out of it. So if they, for instance, have reached retirement age, then they may be quite happy to have a lump sum that there is tax exemptions for it, or maybe low rate. The entrepreneur relief or retirement relief may mitigate their tax. So your strategy would be to present in that way where they take a capital sum. On the other hand, if it's somebody who is not ready to retire and may look to an income stream, then possibly your strategy might be to keep them involved and give them an income stream, or down the line where they stay with a shareholding in the company. Maybe if they're reaching an age, they're not quite at retirement age. I've been involved in a number of transactions where people were keen to do a deal now, but tax-wise it didn't make sense for a couple of years. Well, that can be accommodated in some sort of an option type arrangement. It can be riskier, but it might suit both parties.
Well, if you've just tuned in, that was tax specialist Brian Hennebry, and I would like to thank Brian for sharing his tax advice with us this morning.
Southeast Radio's Business Matters with Karl Fitzpatrick.
South